Welcome to this explainer. Today, we're taking a deep dive into the UAE Ministry of Finance's guidelines to really demystify value-added tax for businesses. If you're currently operating a business in the United Arab Emirates, or maybe you're planning an expansion into the region, understanding these exact mechanics isn't just about ticking a legal compliance box. It is absolutely crucial for running a smooth, optimized, and financially healthy operation. We're going to break down the official guidelines straight from the source to give you absolute clarity on the whole process. Okay, so here's our roadmap for today. First, the basics of VAT. Second, VAT in the UAE. Third, registering your business. Fourth, your VAT responsibilities. And finally, number 5, special rules in sectors.
All right, Section 1, the basics of that. Let's make sure we really understand the global concept here.
So what exactly is value-added tax, or VAT? Well, simply put, it's an indirect general consumption tax imposed on most goods and services that are bought and sold. And this isn't some niche experiment, right? It's a proven, globally recognized system used by over 150 countries around the world. The crucial takeaway here is that VAT is an indirect tax that gets charged at every single step of the supply chain, even though the ultimate consumer is the one who bears the final cost. Now, you might be thinking of a traditional sales tax. That's usually a one-and-done charge right at the final point of sale, and honestly, it mostly just applies to physical goods. VAT is much more sophisticated than that. It's imposed on both goods and services throughout the entire supply chain, not just at the very end. And importantly, it's also imposed on imports. This brilliant mechanism keeps domestic providers on a perfectly level playing field with international imports, which ensures totally fair competition. And this brings us to a massive mindset shift. The ministry notes that businesses collect and account for the tax, effectively acting as tax collectors on behalf of the government. Seriously, this is the most important conceptual leap you can make today. Your business isn't actually bearing the tax burden on its own revenues. You're essentially a pass-through entity facilitating the system for the state. You're managing the flow, doing a bit of the government's accounting for them, but you aren't paying the ultimate price. Moving right along to Section 2, VAT in the UAE, and seeing economic diversification in action. The absolute magic number you need to remember here is 5%. The UAE introduced the standard 5% VAT rate across the entire country back on January 1st, 2018. To put that into perspective globally, 5% is a highly competitive and relatively low standard rate. It's perfectly designed to balance economic growth with fiscal responsibility. So why introduce this in the first place? Well, it's a huge strategic move to maintain high-quality public services while pivoting the economy away from relying solely on oil. By bringing in this tax, the UAE government took a very forward-thinking step toward massive economic diversification and long-term fiscal sustainability. It's basically a mechanism to secure that high standard of living and top-tier infrastructure the UAE is famous for well into the future. Okay, Section 3, registering your business. Let's look at the mandatory and voluntary thresholds so you know exactly where you stand. 375,000 dirhams. That is your mandatory line in the sand. If your business's taxable supplies and imports exceed this threshold of 375,000 dirhams, you are legally required to register for VAT. No exceptions. This means you have to track your financial records super closely so you know the exact moment you hit this number. But here's where it gets interesting, because the system actually offers some incredible flexibility. You can opt for voluntary registration if your supplies, imports, or even your expenses exceed the lower thresholds of 187,500 dirhams. So you don't actually have to wait until you hit the mandatory limit if it makes strategic sense for your business to enter the system earlier. And get this, registering based on expenses allows startup businesses with literally zero turnover to enter the VAT system voluntarily. This expense-based threshold is such a brilliant nuance. It's specifically designed to support new startups before they've even made a single sale. Basically, it means that while you're in that pre-revenue phase, spending money just to build your business, you can register and start recovering the VAT you're paying to your suppliers on all those setup costs. It's a real game changer for new founders. Let's move to Section 4, your VAT responsibilities. We're going to dive into the practical side of acting as the tax collector. So once you're registered, your daily compliance is basically a continuous loop. Step 1, meticulous record keeping. You have to enable the government to verify your transactions. Step 2, actively charging VAT on the taxable goods or services you supply. And Step 3, making formal, regular online submissions to report exactly what you've collected and paid. It is a logical, ongoing cycle.
And this brings us to the fundamental math of VAT. It is all about the difference between what comes in and what goes out. Let's look at net remittance versus net reclaim. If you collect more VAT from your customers than you paid out to your suppliers, well, you remit that positive difference to the government. Conversely, if you pay more VAT to your suppliers than you collected from your own sales, you reclaim the excess. So the crucial point here is this simple balancing act between the VAT you charge and the VAT you pay. That math dictates whether you're cutting a check to the government or getting a nice refund.
Finally, Section 5, Special Rules and Sectors, covering real estate, zero rating, and the government.
Real estate in the UAE has some really deliberate nuances. For instance, commercial property sits at the standard 5%, but residential properties are generally exempt, meaning everyday homebuyers aren't getting hit with huge, irrecoverable tax costs. Plus, the very first supply of a new residential property within its first 3 years is zero rated. This structure is so smart because it protects everyday consumers while still allowing real estate developers to recover their construction VAT costs. And beyond new residential builds, the UAE applies a zero rate to some other specific, essential, and internationally focused sectors. We're talking about exports outside the GCC, international transportation, certain investments in 99% pure precious metals like gold and silver, and highly designated essential healthcare and education services. By zero rating these, the UAE makes sure its exports stay globally competitive and that fundamental social services remain totally accessible to the public without any added tax burdens.
But, what happens if your business straddles a couple of different categories? Well, the rule for input tax recovery is you get full recovery for taxable supplies and absolutely zero recovery for exempt supplies. If you're in a sector like banking that handles both taxable and non-taxable exempt supplies, you have to carefully apportion your input tax claims. You can't just claim everything back. You actually have to use a fair, mathematically sound method, which usually starts with a ratio of recoverable to total supplies to determine the exact fraction of your input tax you are legally allowed to reclaim.
This next part is actually fascinating. The government even applies VAT to its own entities. That's right, government bodies are generally subject to VAT. They are only excluded if they are the sole provider or clearly not competing with the private sector. Plus, they're entitled to refunds to avoid internal budgeting issues. This brilliantly illustrates how the UAE ensures a leveling field. They treat government entities much like private businesses to make sure absolutely no unfair advantages exist in the open market, unless, of course, they're acting strictly in a sovereign, non-competitive role.
So, as we wrap up this explainer, I want you to ask yourself a question. Are you viewing VAT as just another legal hurdle? Or are you ready to use these mechanics to actually optimize your cash flow and streamline your operations? When you truly embrace the structure of VAT, utilize those voluntary registration thresholds for your startups, and master the input tax recovery rules for your specific sector, you aren't just complying with the law. You are actively driving your business forward in the UAE. Thank you so much for joining me on this explainer, and definitely keep exploring these concepts to empower your business journey.